Hmm, what is accounting? So, accounting is the process of recording financial transactions pertaining to a business. The accounting process includes summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. The financial statements used in accounting are accounts summary or financial transactions over an accounting period, summarizing a company's operations, financial positions, and cash flows. Accounting is one of the key functions for almost any business. It may be handled by a bookkeeper or an accountant at a small firm, or by sizable finance departments with dozens of employees at larger companies. The report generated by various streams of accounting, such as cost accounting and managerial accounting, are invaluable in helping management make informed business decisions. There are two methods of accounting that businesses use to document their income and expenses. First, the cash accounting method, and second, the accrual accounting method. What is accounting cycle? Accounting cycle is a process of identifying, collecting, and summarizing financial transactions of the business, with the objective of generating useful information in the form of three financial statements, namely income statement, balance sheet, and cash flows. It starts with an accounting transactions and ends when the books of accounts get closed. There are the 9 steps of the accounting cycle. 1. Collection of data and analysis. 2. Journalizing. 3. Recording the journals into the ledger accounts. 4. Creating unadjusted trial balance. 5. Performing adjusting entries. 6. Creating adjusted trial balance. 7. Creating financial statements from the trial balance. 8. Closing the books. And 9. Creating the post-closing trial balance. Step 1 until 3 may occur daily during the accounting period. Step 4 until 7 are performed on a periodic basis such as monthly, quarterly, or annually. Step 8 and 9 usually take place only at the end of a company's annual accounting period if a worksheet is prepared. Steps 4, 5, and 6 are incorporated in the worksheet.
Step 1. Collection of data and analysis of transaction. In this first step of accounting cycle, the accountant of the company collects the data and analyzes the transaction. For a smoothly running business, there will be many transactions. The accountant needs to look at each transaction, find out why it occurred, put it under the right accounts, and then analyze. This step is the most critical of all because this kickstarts the process of accounting. Step 2. Journalizing. After collecting and analyzing the transaction, it's time to record the entries into the first books of accounts. In the step, each transaction is transferred to the general journal, and under each entry, a narration is written to mention the reason behind debiting or crediting on account. Recording the entries in the journal is important since if there is any error at this stage of recording, it will linger on in the textbooks of accounts as well.
Step 3. Recording the journal into the ledger account. Accounting is a series of steps taken one by one. After journalizing all the transactions, it is time for the accountant to record the entries into the secondary books of account. That means, if there are cash and capital, there will be two tables in the general ledger. Step 4. Creating an unadjusted trial balance. As you know, the trial balance is the source of all the financial statement. That's why special attention should be given to the trial balance. From the closing balances of the general ledger account, an unadjusted trial balance is prepared. In this trial balance, the debit balances will be recorded on the debit side, and the credit balances will be recorded on the credit side. Then the debit side is total and the credit side is also total.
Step 5. Performing adjusting entries. At this juncture, the unadjusted trial balance is already prepared. In this step, the adjusting entries are prepared. The adjusting entries are typically related to accrual adjustment, periodical depreciation adjustment, or amortization adjustment. Without performing the adjusting entries, the adjusting trial balance will be prepared. Step 6. Setting adjusted trial balance. After passing the adjusting entries, it's time to create a fresh trial balance. This trial balance is called adjusted trial balance since it is prepared after the adjustment entries are passed, and as a result, this trial balance can be used to prepare the most important financial statement.
Step 7. Creating financial statements from the trial balance. This step of accounting cycle is the most critical part. As an accountant, we must know how all the financial statements are coming from. From the adjusted trial balance, all the financial statements are burned. They are for most important financial statements that are prepared using the adjusted trial balance. 1. Income statements. The first financial statement that every investor should look and every accountant should understand at is the income statement. In the income statement, the first item is sales and the cost of sales, and other operating expenses are deducted from the sale to ascertain the operating profit. From the operating profit, other expenses are deducted to compute the net profit of the year.
Step 5. Closing the books. 1. This step in the fundamental in the accounting style. 2. Closing the books means such all finance statements, profits, and all transactions have a been record, analysis, summarize, and recorders. 3. After closing the books, a new accounting period will start and the account or do not start refreshing the above step on again. Step 9. Creative pause closing trial balance. 1. To ensure the accounting transactions are properly recorded, analyzed, and summarized, a false closing trial balance is fair. 2. Here all the accounts are taken into account and the closing balance are recorded as fair their respective position. 3. The credit side and the debit side are being matched to see where everything is the right order or not.
Financial statements. What are the financial statements? Financial statements are written reports prepared by company's management to present its financial affairs in a given period, quarter, 6 monthly, or yearly. These statements include balance sheet, income statements, cash flows, and shareholders' equity statement or owner's equity statement. Investors and financial analysts rely on financial data to analyze the performance of a company and make predictions about its future direction of the company's stock price. A financial statement is to determine the financial standing of a business and to measure three main objectives. 1. Profitability is the ability of a business to make a profit. 2. Liquidity is the ability of a business to pay current obligations without disrupting normal operations. 3. Solvency is the ability of a business to pay all its debts if the business were liquidated or sold out.
Balance sheet. The balance sheet is a financial statement provides a snapshot of the asset, the liabilities, and the shareholders' equity. Many companies use the shareholders' equity as a separate financial statement, but usually it comes with the balance sheet. The equation that you need to remember when you prepare a balance sheet is this: assets equal liabilities plus shareholders' equity. The balance sheet total will be calculated already, but here's how you identify them. 1. Look at total asset on the balance sheet for the period. 2. Total all liabilities which should be a separate listing on the balance sheet. It might not include contingent liabilities. 3. Look at total shareholders' equity and add the number to total liability. 4. Total assets should equal the total of liabilities and total equity.
Income statement. The income statement is the next financial statement everyone should look at. It looks quite different than the balance sheet. Unlike the balance sheet, the income statement covers a range of time, which is a year for annual financial statement and a quarter for quarterly financial statement. The income statement provides an overview of revenue, expenses, net income, and earnings per share. It usually provides 2 to 3 years or of data for comparison. Income statement formula and calculation. Net income equal to revenue minus expenses. 1. Total all revenue or sales for the period. 2. Total all expenses and costs of operating the business. 3. Subtract total expense from revenue to achieve net income or the profit for the period. How the income statement work? It starts with the gross sale or revenue. Then we deduct any sales return or sales discount from the gross sales to get the net sales. This net sale is what we use for ratio analysis. From net sales, we deduct the cost of goods sold and we get the gross profit. From gross profit, we deduct the operating expenses like the expenses required for daily administrative expenses. By deducting the operating expenses, we get the EBIT, meaning the earnings before interest and taxes. From EBIT, we deduct the interest charged, paid, or interest received, if any, and we get EBIT, meaning earnings before taxes. From EBIT, we deduct the income tax for the period and we get the net income, meaning profit after tax.
Cash flow statement. Cash flow statement is the most important statement every investor should look and every account should understand. The cash flow CVAs measure how a will company generals to fly to its obligation from its operation expense and from investment. The cash from statement complement the balance sheet and income statement. The CVAs alone influence understanding a company operation are running, where the money is coming from, and how money is being spent. The CVAs also from essence to where company is also finance floating. There are three favorite statements are cost from statement. Three statements are cash flow from the operation activity, cash flow from investment activity, and cash flow from financial activity. 1. Cash flow from operation in the cash general from the account operation of business. 2. Cash flow from investment activity relates to the cash inflow and outflows relates to investment in the company like buying of property, plant, and equipment of other investment. 3. Cash flow from finance activity relates to the cash inflow or outflows relates to debt of equipment of company in consideration of the equity, loan, repayments, buybacks, offset, and more.
Statement of change in shareholder equity. Owner's equity. Statement of change in shareholder equity is a financial statement that provides the summary of change in the shareholder equity in a given period. Shareholder equity is a company's total asset minus its total liabilities. Shareholder equity represent the amount of money that will be returned to shareholder if all of the assets were liquidated and all of the company debt was paid off. Retained earnings are part of shareholder equity and are the percentage of net earnings that were not paid to shareholder as dividend. Statement of change in shareholder equity. Statement owner's equity. 1. Common stock is the first and most important component of shareholders' equity. Common stockholders are the owner of the company. 2. Additional paid in a capital means when the company receives a premium on the shares. 3. Retained earnings or loss accumulated from the previous period. In simple terms, retained earnings are the amount the company keeps after paying the dividend from net income. 4. Treasury shares are the sum total of all the common shares that have been purchased back by the company. 5. Accumulated other comprehensive income contains unrealized gain or loss that don't flow through the income statement.